From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. This is Tony Fratto. You're listening to the HPS Macrocast. I'm coming to you from New York City. My colleague, Matt McDonald from HPS, is in the studio in Washington, D.C., as is John Fagan from Markets Policy Partners, and our good friend Mark Sobel, my former colleague from Treasury Department, John's former colleague from Treasury Department. Now, Mark is the U.S. chairman for OMFIF. Mark, you could tell me OMFIF. I can't always forget. I forget all my acronyms.
OMFIF, the official Monetary Financial Institutions Forum.
There we go. Thank you. And it's a Jobs Day Friday, and coming off of a really wild week in the markets. We just got the jobs report. Matt will run us through the numbers here, but a wild open to the market. The 10-year note is down around 0.7%, which seems otherworldly for if you've followed the 10-year for any length of time. And the market, the Dow's down about 750 points. All the markets across the board down around 3% fall, which would put us into a negative week. But we do have and we have coronavirus and elections going on. And later in the show, we're going to talk about a really interesting paper that Mark wrote about the Treasury Department's work on trying to get the Chinese to reform their currency policy, and it's a terrific paper. And we'll talk about it more later in the podcast. But first, let's go to the non-farm payroll numbers. Matt, what do we got?
So this is the best jobs report that nobody will care about. Is the top line number was jobs increased by 273,000 in February. This is over. The consensus was around 175, so it's a good number and a nice beat. The unemployment rate ticked down from 3.6 to 3.5, though it's been alternating between 3.5 and 3.6 for about 6 months now. So, it's down again, but we're around the same level. I think if you start going out to the hundredths or rounding, is that it's probably right around the border on those pieces. Likewise, average hourly earnings continue to grow. It's been 3% increase over the trailing year, and then the other thing, even beyond kind of a really good 273 number, is that revisions were up in December and January by a collective 85,000. So those numbers went up too. If you look at the January numbers, actually, it was revised up 48,000 to 225, or from 225 to 273. So after revisions, we actually had 273,000 jobs added in both January and February, which is, on the jobs front, at least, a great start to the year, despite all of the other chaos swirling around us.
Yeah, by any measure, and if we didn't have coronavirus concerns and what we're seeing with what may be a sudden stop, this is a blowout jobs report, right? I mean, it's there isn't a single troubling number in this. So workforce participation is great, wages are great, the revisions are great. So I guess if you're going to go into a coronavirus economic shock, you want to go from a position of strength, right?
Even if the Fed doesn't have a lot of room to operate, at least the job market does.
John, what do you think about the numbers?
It is, as Matt said, this is taken by the markets as something in the rearview mirror and rapidly disappearing into the background here, as market participants peer ahead at what they expect to be an increasingly acute headwind from the outbreak. So we really didn't expect any sort of major market reaction, and that is proven out by the price action resulting, which was barely a flutter in 10-year Treasury yields and 2-year Treasury yields, which, as you pointed out earlier, Tony, are extremely depressed this morning and trading consistent with an exceedingly grim economic outlook.
They're now below 0.7 now. Just saw a 0.692 flash on the screen, which is crazy.
It really is, and it is that fact alone, where the 10-year is trading right now, is very troubling for equity markets. It is a warning, and a loud warning signal, and this is coming as we've seen. Obviously, this week has crystallized a lot of the concerns that were building over the past month as to the global nature of this outbreak. So, but as we discussed, it's not showing up right at the moment in U.S. economic data. So investors and analysts are going to be pouring through some of their more high frequency data and some of the early indications of this month to try to see where how bad this might be impacting us at the moment and in the future.
Could you, hey, John and Mark, could we just take a minute on the 10-year? Because I'm not sure that most people really understand just how wild this is, right? So what exactly is going on there? So we know that so just if people aren't familiar, price and yield go in opposite directions. So I don't see the price of the 10-year in front of me, which I know I can dig up, but price is being bid up and the yield is lower, and generally that means that people are flooding into buying 10 years as a safe asset. What is it? Is that what's happening here, and what is it? Explain what it means for the outlook.
Yeah, absolutely. So thanks, Tony. The 10-year yield, when analysts and traders look at the 10-year yield, that is one part of the Treasury yield curve. When they look at the 2-year, for instance, the 2-year is much more driven. The 2-year yield is much more driven by Fed policy expectations, and the 10-year and we see now the 2-year is trading right now at 40 basis points. The Fed, we'll talk a little bit about this in later in the show, but the Fed engaged already in 50 basis points of emergency rate cuts on Tuesday of this week, and bringing the policy rate into a range between 1.25 and 1%. The 2-year yield is reflecting expectations of many more cuts to come, and so trading at 40 basis points is at the 2-year is telling us much more about the expectations for Fed policy. The 10-year obviously incorporates the 2-year yield, but also on top of it, also baked into the 10-year yield are expectations for growth and inflation, and that is right now at 70 basis points or below 70 basis points. That's consistent with an exceptionally downbeat, grim, recession level economic outcome down the road in the medium term. That's not 10 years out. This is 10-year reflects sort of medium to longer term expectations. And as you say, layered on top of these expectations of policy growth and inflation is the accelerant here is clearly a safe haven bid, with investors running into what they see as the safest harbor in a gathering storm here, and that is still the Treasury market, and it's right now we're seeing that play out in a very historically rapid decline in yields. And it's sending some real warning signals here.
Before we had a little bit of discussion before the podcast about why the dollar is actually off its size. Ordinarily, what you would see in when there's a flight to safety event. The traditional thing you see are U.S. Treasuries bid up, the yield come down, dollar strengthening because people need to, exchange their foreign currencies to buy dollars in order to buy U.S. dollar-denominated assets like treasuries, and so the dollar is usually bid up. What's unusual, is that the dollar is off its highs, and my guess on that was that it's really people holding dollar-denominated assets are reallocating from risk assets like equities to treasury, so they're not having to go out and buy dollars in order to do that. They can do that all within dollars. What are your thoughts on that?
Yeah, I think that's right. The as you say, the typical formulation in a high stress market environment is equities sell off, treasuries rally, and the dollar appreciates. The problem that is in some respects good, because that shows an investor belief and faith in the dollar and dollar-based assets. On the other hand, it tends to be pretty pro-cyclical. As the dollar spikes up, it can cause problems for companies with currency mismatches, dollar debt. If they have they're typically making money in another currency. It tends to be very hard on commodities markets. It tends to be very difficult for emerging markets, and very deflationary. So a surging dollar, while it shows faith in the United States and the greenback, it is a pro-cyclical dynamic. The fact that the dollar right now is depreciating off of what were multi-year, multi-month highs into the middle of its range. It's not as though the dollar is falling off the table. It's falling back into a trading range that had been established for a number of years. And that is in our view, it's a recalibration of expectations that the U.S. would be relatively more insulated from this outbreak than Europe and Asia. And one of the pieces of evidence we think gives us faith in this conclusion is that earlier in the outbreak, when we saw Asia really be, China and Asia, North Asian countries being the epicenter, the yen failed to have its typical safe haven characteristic appreciation. The yen fell as well, and now the yen is making a comeback here, and we think that's a recalibration of the understanding that the U.S. would be an island, an oasis of health in this outbreak, and we think that probably dollar weakness will peter out here, but the understanding that this is really a much more global and uniform across the world impact.
Can we talk about the impact a little bit? I mean, I think it seems like such a long time ago, but it was just really 3 days ago that Jay Powell came out with an emergency rate cut, 50 basis points that was supposed to shock the markets. The Fed is clearly seeing some potential weakness that it's trying to protect against. How do we feel about that? We were the ones, I think, a couple of weeks ago saying the market seems to be underestimating what the economic impact is going to be. They're not underestimating it anymore, but are they close to target, or is this a panic?
Well, so right now, it's a very important distinction to make. There's price action that is reflecting stress and investor fears, and that is adverse and stressed price action. But what is even more important from the policymaker standpoint, and really from the financial market standpoint, is that structural. How much structural stress are we seeing? There's a distinction to be made there, and obviously, with the kind of volatility that we've seen and the expectations for increasingly acute economic and human fallout from this outbreak, there are more fundamental and deep-seated problems that traders and analysts are now monitoring. And these are basically credit stresses, dollar liquidity stresses, both in the funding markets here in the U.S. and overseas, interbank funding. Right now, none of these are at super stressed levels, but they definitely bear watching. They're not necessarily going in the right direction here, and so That's a key distinction, whether the downbeat price action remains orderly. As of now, it is remaining orderly. The market reaction to the Fed on Tuesday looked, on a superficial basis, looked a little bit, not exact, a little suboptimal, because equities sold off after Jay Powell's press conference. I think that's a little unfair because S&P 500 had rallied to 4.6% the day before, and so it had bounced pretty significantly. So it was going to be tough for the Fed to give the equity market a lift after that kind of preemptive rally on Monday. And you had a situation in which, the futures markets immediately moved the goalposts on the Fed, and so there was discussion about how much more the Fed is going to do. Well, the markets have made up their mind that they've got another 50 basis points coming at the March 18th meeting, another 50 basis points with a rising chance of 75 basis points being cut. Over the next year, the futures markets are reflecting almost 100 basis points. That would be 4 25 basis point rate cuts, but right now it's reflecting a much swifter start. So 3 full rate cuts are priced in by April. And this is alongside expectations that the Fed will be beefing up its liquidity operations, turning its current asset purchase program into something much more like a QE, or even explicitly firing up quantitative easing, which is large-scale asset purchases out of with a longer duration in the Treasury market.
If the guests can pipe in.
Please.
Always, please.
I mean, the market reaction had a little buy the rumor, sell the fact quality to it. And there's this whole clamor to do something from the market, sign of desperation. So the Fed cut. And the way I put it is that the market's got their fix. But it's worth underscoring that in many respects, the coronavirus is a supply shock, right? If a production line is closed down, cutting interest rates is not going to solve that problem. Now, the Fed cuts can help support asset prices. Not clear how much good that's doing to this, but in principle, it can support asset prices. It can help deal with confidence issues. It can deal with some of the stress issues you suggested. But I still have a fundamental question about how much good are the Fed cuts going to do for the economy? And in my mind, the action really should be on the fiscal side. I think we need targeted measures to help small businesses keep their liquidity, maintain their liquidity in a period of uncertain demand and whatnot. So I offer that comment.
Yeah, I think that's absolutely right. And from our perspective, the Fed's action on Tuesday was really about trying to keep markets from making an economic, obviously a challenging economic situation worse. Markets have the ability to magnify negative economic outcomes with pro-cyclical price action. If the Fed had withheld rate cuts this week and had said, but for its emergency rate cuts, we would have much more likely seen a full inversion of the 2-year, 10-year yield curve, which screams recession. We would have seen the dollar potentially rise and break out to the upside. And so it's kind of a do no harm, trying to keep markets from making things worse. And I think that's right now in the market, the market signals are that the Fed is on the right track. And the other thing I would say is the Fed has established this as a pattern for a decade. And for the Fed now to say, we're not going to do it, we're going to apply some real tough love to the markets, my own opinion would be that now is not the time for that. If you wanted to do that, maybe 2014, to establish that.
Well, why don't we do this? I actually want to go deeper into that a little bit about what the response ought to be and how we think about what the outlook is. And so why don't we take a break here and then come back and dive into the government response just a little bit and see if we can make sense of where we think that's going. You're listening to the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
We're back on the Macrocast. Tony Prado in New York, Matt McDonald in Washington, D.C., along with John Fagan and Mark Sobel. So, hey, guys, one of the things when you think about what happens is sort of, activity, the economic activity, we're all economic actors ourselves. Have you canceled any trips? Are you hoarding up on toilet paper and bourbon?
We're hoarding up on board games. So
board games.
We're in anticipation of school potentially being out. Is that our biggest threat we perceive in our house as bored children? So we actually
how much money can you spend on board
It's
games?
interesting. I will say we had whatever we spend, it will return in manyfold in distractions. We have spring break coming up. We have and we're going skiing in Vermont, and we were already planning to drive. So we're just same old plan. We're doing that. I do have friends whose we had a friend who had a spring break trip planned to Japan, and they canceled that. And so that's Japan though. So I think there's some changes.
President has been saying, well, look, the sort of the silver lining on this is that, people are canceling their overseas trips, but at least they're spending, traveling domestically. And the only, counterpoint to that is, I think, Southwest Airlines CEO was on CNBC yesterday, and he said that 97% of his flights are domestic. I presume the others go to maybe Mexico or Canada. So 97% of his flights are Mexico are domestic, and the impact looks a lot like 2008 to him.
Yeah.
So it was a real fall off even on domestic flights. So but
we should mention Tony that HPS has their cases that have been announced in Montgomery County here, right next to DC, and HPS has closed our office. I mean that we've done that. Yeah. Now the interesting part of that.
That's a big hit for Devin and Blakely.
That's right. The interesting part of that is that for us we're moving to remote work, and for us it's not actually that big a deal. I mean, we probably would have remained open if the risk reward calculus were different, but it's kind of the risk is there and the reward. It's nice. It's good to be in the office and we do better work together, but it's not really that big a deal.
Yeah, and I think that really segues into a really interesting point, because when we think about government support for impacted industries, we think about big auto company bailouts of big banks, or even mid and small sized banks. It's quite a relatively concentrated and sometimes highly regulated industries that have a lot of government ties. The service, you mentioned Devin and Blakely, the terrific sandwich and salad and soup shop downstairs, and restaurants around town and the bars and that sort of thing. It's a much different kettle of fish.
Yep.
And how does the government respond to that?
I don't think it's insignificant. I mean, look, I think there probably is some shifting around. So like that spending doesn't go to zero. Right. I mean, it goes to. So if you're not going to sporting events or movie theaters, you have to eat. But if you're not going to go to sporting events or movie theaters, maybe you're going to spend some money on, streaming and renting videos on TV on demand on TV, and maybe there's some other ways you're going to spend it. So I don't think the spending doesn't go to zero. Yeah, board games. You could buy. I don't know how many Monopoly games can you buy.
Purell,
lots of Purell and toilet paper and bottled water.
I mean, look, I mean, I think the other interesting thing about all this is that I think that we will know a lot more about what this is and isn't in a month. Like, I just think that there's going to be, there's a lot of speculation and a lot of uncertainty, and I think that's what you're seeing in the markets. I don't think that there's like a great sense of what this is really going to land and how it's really going to look.
So Mark, if you were back in your old job as the Deputy Assistant Secretary for International Affairs at Treasury, and in your or in your seat over at the IMF when you were executive director, U.S. executive director over at the IMF. What would your conversations be like with our counterparts on this? I mean, are there opportunities for coordinated responses? I know that there's lots of information sharing, but is there activity that could happen that might be beneficial between the major economies?
So that's a tough question. Let me just say that I know that the markets were very unhappy with the G7 statement. Mm-hmm. To me, the G7 statement was not unexpected. I had more of an issue with the market's expectations of the G7. I think they're looking for a white knight, and I think we're all flying somewhat blind given the coronavirus.
But my question is, what would the white knight have been carrying anyway, right? I mean, like, it seems like the central banks can coordinate, but what would the financial ministries be coordinating?
Yeah. So I agree with you there. I would say, back in 2008, the IMF and some of the major countries put out this $5 trillion fiscal plan, right? So in the G7 statement, they say, well, we're going to do our as appropriate and they're going to look at fiscal and monetary and financial sector policies. On monetary policy, we saw the Fed rate cut, but again, the ECB's in a different place than the Fed. BOJ's in a different place than the Fed. So they can be cooperative, but the notion that these coordinated interest rate cuts that we saw back in 2008 and 2009, I think that's a bit far-fetched in the current circumstances. Yeah. Countries have different fiscal space. But to say we're going to look at what we can do on fiscal and we're going to do it is perhaps a statement of the obvious, but it's useful. So I think that presumably there are conversations of that nature going on. I think that the central banks and the financial regulatory and stability officials need to be looking at how strong their banks are and the like. I would say the banks, if I were the Fed, I'd be telling the banks to look at their lending portfolios and stresses, and can they maintain liquidity for small firms, have loan modifications if needed, and whatnot. So I think there's just a lot of things that you can do, a lot of things you can talk about, but it's just not a home run where everybody locks arms and says kumbaya or bonsai and attacks.
So Matt, what do you think we ought to be doing in a sort of domestic program? Is there a way to target any of this?
I mean, I actually thought that a lot of the and I think what Jason Furman was talking about along this, and I've heard a number of people say that if there's stimulus that it ought to be responsive stimulus, effectively like structured in such a way that you put out the commitment now, but that it is adaptive to whatever the reality ends up being. And I actually think that's a super smart approach in terms of, listen, like that's an approach that doesn't. We don't know how serious or not serious this is going to be, but that gives markets and economic actors confidence that there is a plan in place, and that it's not in it. It has this quality of kind of like, okay, you don't have to worry as much about what if and if this happens and all the rest of it, because you already have the answer, and you can always change that answer if needed. But that approach seems to me like a good starting point. Now the fight in Washington is typically over the composition of the stimulus, which in some respects feels like the secondary question as compared to the structure. I mean, I don't think that it's necessarily, to me, it doesn't make a ton of sense to come out hard right now with hey, we're going to have $1 trillion stimulus. Like in a month, that could just make no sense at all. Like it's not clear to me that this is going to be either a big deal or not a big deal, or it just, there's a lot of uncertainty. I think a contingency stimulus that is like based on some factor or something that has a it'll automatically ramp up or ramp down or what have you. That seems like, a smart policymaking approach in the context.
So if unemployment ramps up, you could increase unemployment insurance. You could have a payroll tax cut is what you're saying.
Yeah. And I think I think there's a couple of specific pieces that policymakers ought to be thinking about. There are going to be portions of jobs and people and the economy that are going to be able to weather this pretty easily. Tony, the reason we shut down the office because it's not really that big a deal and we can still continue to do our work. If someone is back in college, I was a waiter. So if I'm a waiter and nobody's coming into the restaurant, I'm not getting hours.
You're screwed.
I'm not paid. So there's I think there needs to be some thinking through the responsiveness on that side of it. It's ironic that we're having these big political fights over healthcare. This is a scenario where this isn't really a healthcare quote unquote problem on some level. It's a public health problem, which is a context where, the role that government plays in a public health crisis is hugely important. So that's not as much a debate over how do you most effectively structure your healthcare system and deliver healthcare. That's just a different problem. So, but those are the types of policymaking questions that people need to be wrestling through at this time.
Yeah, I agree. All right, why don't we take a break there? I'm going to get back with our guest today, Mark Sobel, and talk about some Chinese currency issues. What I think we're going to be talking about for a long time. But how did we get here? This is Tony Fratto with the HPS Macrocast, and we'll be right back.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
And we're back on the Macrocast. Our guest today, Mark Sobel. Mark and I worked together at Treasury when I first walked through the door in 2001 until I went to the White House in September of 2006, which I don't know if you remember, was right after Hank Paulson's trip to China. I think I sort of got off the airplane and went straight to the White House, and it was bookended at least a big part of the Bush administration efforts talking about China, and of course you were there for Obama administration work on this also. But it was, so I was at a lot of those, the G meetings and the dialogue meetings we have, the Chinese bilateral meetings in various places, and part of those sort of early efforts to try to get the Chinese to move towards a more market oriented exchange rate, and also the politics around it back here. I remember, being with, Secretary Snow and Charlie and Chuck Schumer, and Schumer this is in 2003 or whatever, talking about how the renminbi is 40% undervalued, and 10 years later, despite everything that happened, everything that changed in that period, he was still out saying that the renminbi was 40% undervalued. And so, sort of it's not that the Chinese exchange rate didn't have an impact, but there have been a lot of politics and talk around it, and the idea that before the Trump administration, nothing had been done. Your paper shows a lot of, in great detail, what exactly had been done. And, what was your inspiration in writing it? And then walk us through that a little bit.
Well, first of all, I thought we all needed a brief respite from the coronavirus. So Tony, you just said it. You were at Treasury for 6 years or so. John was there for several years, and I was there throughout. And this issue was one of the dominant, if not the dominant issue that we had to cope with on the Treasury International side. It was a major part of our lives. And the U.S. view has always been that Treasury was ineffective, the U.S. policy was misaligned. You know this better than I do. People would look at the foreign exchange report, which we all had a hand in, and if it didn't say Manipulation, they just tossed it in the wastebasket when there was a lot of good work in there, and the Chinese were just seen as being malevolent, and we were being seen as snookered or stooges and whatnot. And I have a very different view as an insider. I believe that we gave it our all. I believe that we very heavily engaged the Chinese, and we put forward all types of arguments to help move them along. We put pressure on them. And I believe that in hindsight, our efforts were largely successful. They may have been too slow, but you can see lots of success in it. So I wanted that on the record for history's sake, because you, people like us, but all the Treasury secretaries, all the team at Treasury, we gave it our all, and I think we delivered quite a bit.
And Mark, just a question on you mentioned the foreign exchange report. Obviously, it's a cornerstone of how the Treasury engages with global currency markets, and makes itself understood. Talk a little bit about. You said that market participants, particularly, would tend to throw it away if it didn't designate anybody a manipulator or so forth. What was really behind that tension? And certainly it wasn't just with market participants; it was also on Capitol Hill. What was the real tension between the Treasury's designation or reticence to designate China as a manipulator and versus the pressure from other quarters?
Thanks. That's a great question. First of all, I should say that the frustration that existed among American workers and in Capitol Hill is totally understandable. American jobs were being lost. People were being hurt by the Chinese currency practices, as well as globalization, et cetera. And there were legitimate issues there to be raised, particularly in the 2005-2008 period ahead of the crisis. So everybody said, why the heck didn't you find manipulation? There was a legitimate case to do so. There were huge debates. As I mentioned, the current account was excessive. The currency was highly undervalued. Reserves were rising sharply. The elements were clearly there. I would say on the other side of the ledger, and this was important to senior Treasury officials and the Secretary. So China had begun appreciating its currency in mid-2005 after heavy 2 years of pushing and pressure from Secretary Snow. And then when Hank Paulson came into Treasury, it continued to appreciate from mid-2006 until mid-2008 when the crisis began. So appreciation is what we would have wanted to have happened. So we were getting results. You can say not enough and whatnot, but we were getting results. The foreign exchange report legislation basically said, well, if you find manipulation, you have to start expedited negotiations to remedy the problem with the country. So think about it. All of us are going to China all the time. Secretary Paulson's on the phone all the time. He has created the Strategic and Economic Dialogue, which is this whole government-to-government discussion twice a year. So you could argue we're negotiating already, which is what the legislation called for. Another consideration is, would overt naming and shaming of the Chinese be helpful? So you and I have enough experience with the Chinese to know you put a gun to their head, they're not going to cooperate.
Right.
But if you can stage manage your pressure appropriately behind the scenes with some public pressure, they will be responsive. And finally, there were big debates in Washington and Treasury as well as elsewhere in Washington. If we had designated China, would that have made Capitol Hill happy? And Capitol Hill would have said, fine, Treasury, we'll leave you alone, we'll give you all the space. Or would Capitol have said, well, here are 100 pieces of legislation, we want to help you. And I think that the sense inside the Treasury was that the latter was more likely than the former. So we were getting results, so that was why.
Just a quick question on the last August, the Trump administration, the Treasury did label China a currency manipulator. Could you tell us a little bit about your perspective on that particular episode? They've since withdrawn it as part of the Phase 1 trade deal. But I'd like to hear your thoughts on that particular episode.
So, in 2018, when the Fed was tightening, was lifting, the dollar rose against all emerging market currencies, less against the RMB than others, but it was going up. And then the president started ratcheting up trade protectionist rhetoric and Chinese tariffs and whatnot. So the market thought, well, if there are going to be tariffs on Chinese goods, that's going to decrease the competitiveness of Chinese exports, and therefore they took the RMB down. It finally, in August of 2019, went below 7.0, which you and I know the difference between 6.999 and 7.001 is irrelevant. But 7 was seen as psychological. And so I think what happened, apparently, is when the president saw the RMB go below 7, he was infuriated, and he called the Treasury up and said, just designate them a manipulator. So even though the report is notionally out in April and October, Treasury put out a one-pager saying
they're designated.
And I thought it was unwarranted and unwise. Again, the indicia that Treasury uses to look at whether manipulation is occurring is you look at the current account, so plus or minus 1% of GDP, well below even Treasury's threshold. They're not intervening. Reserves aren't going up. They haven't been going up for years. Many people say the currency's fairly valued. Trump gets upset about the bilateral bounce. Economists would say bilateral bounces aren't particularly relevant. So I thought it was extremely inappropriate and ill-considered. And again, the RMB was falling because of Trump's trade rhetoric. But that's what the Treasury had to do.
It seems to be like the designation, which was hanging out there for so long, it had more power as a threat than it did in its actual use, right? In a sense, they've sort of defanged the currency report now because what followed is what we all kind of knew is very little that you can do by designating them. So the teeth of it were never really there. The Chinese clearly did not want to be designated, and a lot of our conversations with them were always, their great concern that we may designate them, and then it happened, and nothing happened.
So
right?
I agree with you. Of course, the circumstances were so politicized, it didn't look credible. I would say of one thing. I agree with you that the designation per se may not have much teeth, and nor does the legislation surrounding the Treasury report. But there are other things you can do, like slap tariffs on them or something like that. That could be
right.
Could have teeth. And then the other thing is China's big. So if you're thinking about a Southeast Asian country that may be engaging in somewhat harmful practices, their Treasury's big, they're not so big. I think there's a case for more leverage.
Mm-hmm. With the designation.
Or using the designation as a way to talk to them and say, let your currency rise or be more transparent and whatnot.
Yeah. No, I think that's true. I agree with you on that. I just our discussions going on at the IMF in the United States begin discussions at the IMF with the Chinese on their currency practices. I mean, that was what
way back when or now?
No, now. Now, right? That's what was supposed to follow designation is, that we go to the IMF and sit and have some kind of ill-defined, undefined kinds of, almost an arbitration kind of setup with the IMF. Now, of course, the IMF has done a lot of analysis, you noted, on the Chinese currency, and so they have it has its own views on this. But the steps that ought to have or that would follow are, like I said, they're pretty undefined.
So, if my recollection of the 2015 so-called Bennett Amendment are clear, one of the measures that should follow would be that there would be consultations between the executive director's office and the IMF. I'm sure those happened. I have little doubt that they did, and I have little doubt that the IMF reiterated its position, which is that the RMB is fairly valued and that they have a small current account surplus, and there really isn't an issue here. And now, I think when you were Treasury, when we were having discussions with the IMF, at that point, those were much more serious and net of some discussions.
Yeah, I agree. If you so the Chinese today, if you think about the goals that we were through a few administrations trying to achieve, where would you put us on that continuum of getting them to think more about markets? I mean, our view was that having a substantially undervalued currency for any point in time is it's harmful domestically. There's a view even back here that there's an advantage to having an undervalued currency, but it's two-sided, right? There are costs to it, which is something that we were trying to impress also. Has that message gotten through? I mean, do you think are they believers in that, at least on things like currency?
So what I want to say, and maybe wrap up, is that I believe that the strategy of engagement that the Bush and Obama administrations pursued was successful. I believe that we brought the best arguments we could to persuade them. I think that, as you said at the outset, China's sovereign. It's got ugly domestic politics. And so we had to we were but another voice in China, but we had to make arguments that made it appeal to the self-interest of the economic community and the leadership to appreciate the currency. And I think that we did that. I think that the arguments got increasingly sophisticated under all of the various secretaries. And I think that on the whole, we were able to resist protectionist pressures at home that the Bush and Obama administrations did not think were prudent. So I think now, if you go to the Chinese central bank, they're not really interested in playing currency games. They've got enough problems at home. So I think the Chinese thinking has evolved considerably on this front in a direction that we want, and that our pressure, our argumentation was an important factor in China moving.
Mark, thanks for coming on to join us to talk about it. It's great to see you. If you want to read the full paper by Mark, you can find it on the OMFIF website. You can follow Mark on Twitter at Sobel, SOBEL _Mark, MARK. Where you can also link to his paper. Thank Matt for joining us today on his usual jobs day, and John Fagan from Markets Policy Partners. We'll get Brendan in here next week. I think Brendan will be back. But everyone have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter at Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.